I love teaching technical analysis. So once again, today's class is sponsored by USGFX. And if you want, while we're getting the class going, you can go to www.usgfx.com and open a demo account and go roam around the site, see all the facilities they offer you. They are regulated by the Australian Securities and Investment Commission, so you know you're dealing with a transparent broker. All your funds are segregated. All withdrawals are done within 24 to 48 hours, and they have ultra-fast trade execution. You also have negative balance protection and a dedicated account manager. What else could you ask for? You can trade currencies, indices, commodities. They have low spreads, very little slippage. They offer 24-hour-a-day support. You also get tools like Trading Central, Zulu Trade, and all kinds of technical analysis information. They have won awards all for consecutively over the last few years. So you know they are a regulated leading provider. They offer many different services on their platform, and you will get the leading currency and CFD broker in Australia. They're headquartered directly in Sydney, and you can go by their offices and say hello. They offer 60 different currency pairs, so you can always find something to trade. You can also trade CFDs for equities, indices, and commodities. So you can trade gold, silver, oil, all the leading commodities around the world. They've been in business since 2006. So that means they have 11 years of a solid reputation. And they are, once again, regulated. Their license number is 3072792. You can go check them out on the Australian Securities and Investment Commission website. They offer many different platforms. You have the MT4, the MT5. You can use their social trading. You can use their MetaTrader mobile or their web trader. Or you can have multi-terminal. You decide what you need, what you want, and how you want to trade. And they're there to help you get it all set up in the best way possible. Now remember, when you're trading, especially with a regulated provider, we will constantly remind you that risk is an important factor. And money management should always be considered because you can always be on the wrong side of a trade. Now, with USG, you'll also get daily technical analysis reviews. You'll get trading signals directly from the MT4 platform. You get all types of online technical research, and you also have live Forex TV, keep you up to date on everything that's happening in the marketplace. You can also join their VIP club or their Traders Club and get many other products. You can attend their Traders Masterclass. You can have intraday reports. You have up-to-the-minute daily video reports and alerts and signals. You decide what you need, what you want, what facilities you want, what tools you want to use, and they are available for you. Now, as a special webinar promotion, for those of you attending today, if you decide to register and open an account, you'll get, number one, upgrade to the Traders Club. You'll get Trading Central services, and you'll get a $500 deposit bonus on your $5,000 first deposit. So there's lots of reasons to trade and lots of reasons to open at least a demo account during this webinar. An extra $500 never hurts. Now today's class is also being recorded. So if you want to see a recording of this class at a later date, just use the link you used to come to today's class and you'll be able to watch a copy of that recording. It takes about 24 hours to be available, so remember, I'll wait till about tomorrow and you'll be able to see a recording of the class. Now today, we're going to be talking about technical analysis. And the whole idea of whether you're using fundamental or technical analysis is to find the best opportunities. Now, there are two schools of thought when we come to analysis. We have fundamental analysis, which is trading from press release, earnings statements, news, headlines, economic reports. These are easy things to digest and understand. So if Apple comes out and says Apple watches are selling like crazy or Apple iPhones are breaking sales records, you can expect Apple to go up. Okay, that's fundamental information. Doesn't necessarily mean it's going to be right, but none of that information will tell you how high Apple should go or where you can expect maybe some response from traders. Nothing's going to tell you where you should put your stop loss or your take profit point. So you go buy Apple to go up. You stay in the market too long. Apple soars all the way up, but 2 days later it comes crashing back down. You could have made a ton of money, but you didn't get out of the market at the right time because this fundamental news can't tell you entry points, exit points. It can just tell you maybe whether a stock or an asset's undervalued or overvalued. Now, learning to get the most out of the markets using technical analysis will help you trade more successfully because technical analysis will help us understand price points that are important, levels of what's called support and resistance. These are areas when price is moving up because price doesn't move in a straight direction. Price moves in zigzags. So even though you see this line on a chart going straight up, when you look at it closely, you see it's in peaks and valleys, peaks and valleys, peaks and valleys. Okay. You need to understand what these peaks and valleys are telling you because what level price might hem and haw. Where will the buyers or the sellers take a breather? Are they just taking a breather or are they jumping off the ship? This is important. These are called retracements and reversals. But you only will get this from technical analysis. So technical analysis is the study of market action primarily through the use of charts. Now, charting is ultimately important no matter how you want to trade, no matter what strategy you're going to use. Okay, no matter what asset, you should be able to look at a basic chart and see a story. And anytime you look at a chart, even if you're looking at a bare line chart, which is just a number and a line drawn on a chart, this falls in the realm of technical analysis. Okay. So technical analysis doesn't have to be as scary as some people think it is. Okay. Now, technical analysis is based on 3 assumptions. Price tends to repeat itself, price moves in trends, and the market discounts everything. Now, as we talk about these, we're going to be talking about things that maybe you don't understand yet, like what exactly is a trend, or how do I draw a trend line, or all the ways of getting support and resistance. Well, if you're not sure, use some of the USGFX education materials, watch their videos, read their booklets, use their ebooks to understand what these fundamentals are because you have to learn the basics. You have to start technical analysis from building a foundation. Okay, all of the squiggly lines and squiggly charts that get you all complicated and confused and using big terms like Elliott wave pattern and Fibonacci number can scare you to death. Okay, but you don't start out from there. You need to start out with the basics. Okay, and you need to understand where this all comes from. Now, technical analysis is widely used among traders and financial professionals. As some studies say it is more widely used than fundamental analysis. Technical analysis is a methodology that makes buy and sell decisions using market statistics. It primarily involves studying charts showing the trading history and statistics of whatever security is being analyzed. So technical analysis works the same for indices as it does for stocks, as it does for commodities, as it would for Forex. There are certain indicators that work better for each market or that you would adjust for each market. But the basics, whether you're using a line chart, a bar chart, a candlestick chart, whether you're reading candlesticks, whether you're using RSI and stochastics, whether you're using momentum indicators, are all different. But actually putting a trend line on a chart, reading the price on the chart, seeing volume on the chart, and finding support and resistance on the chart are the basics of all charts or all technical analysis systems, regardless of what market you're trading in. So to perform technical analysis, investors start with charts that show the price and trading volume history of a particular security or index, as it hosts other statistical measures as well as moving averages and percentage changes. The idea is to use a chart to identify trends and changes in those trends. There are several kinds of trends and patterns. Some of these have unusual names like rectangles, triangles, Bollinger Bands, inverted head and shoulders, candlesticks, MACD histograms, stochastics, and so forth. Some technical analysis also use indicators and oscillators to interpret data. Scares you to death, doesn't it? Confuses you to. Okay. Well, Technical analysis can be as complex or as simple as you want it to be. So it's basically building your roadmap to success. And you can see charts that almost look like this roadmap of London with all kinds of squiggly colored lines going all over the place. But you need to start off with a proper foundation. Now, I've been trading for 40 some years now. Yeah, I'm that old. And back in the old days, we didn't have GPS in our cars. And we used atlases and road maps to get everywhere. Now, me, I'm kind of lazy, or in that case, I was lazy and not detailed, and I wasn't really good at looking at these things. So I would call and find out where my next appointment was, and I'd ask somebody, okay, what highway to get off, what exit do I get off, and where do I go from there? And I'd write it down on paper and pencil. And I'd always have to leave for a meeting a half hour, 40 minutes early, because I knew I was going to get lost. I knew I'd have to pull into a filling station to ask directions. I knew eventually I'd get there. Now, my business partner in those days, well, Peter could read a map inside and out. So when I went to Peter for the meeting, he'd pull out the atlas. Not only would he tell me what main highway to take, he'd say, you know what, it's getting to be rush hour. Maybe we should jump off and take, the surface roads and then go to the roundabout, take the third roundabout, past the filling station, go up past the school, and then look for that first parking lot. And we would get everywhere we wanted to go, never getting lost, always early. And even when we had to travel from London to Scotland or London to, and by car, we got to travel London to France, we took the ferry, wherever our meetings were, we would never get lost. And he would know right where the hotels are, where we should pull off to eat, right from his little maps. Well, I was one side of the extreme. He was the other side of the extreme. But if you thought of a roadmap as a chart, and that's exactly what it is, this atlas is your chart. You can be like me and only put a couple lines on there and keep making mistakes. Or you can be like Peter and draw all these complicated chart analysis. But the fact is, we can settle for somewhere in between that you can keep building onto. So unlike fundamental analysis, which focuses on finding a security's true value by studying financial statements, market outlooks and competition and macroeconomic events, technical analysis is based on the belief that past market trends can predict future behavior of the market as a whole and for individual stocks. If an investor can correctly interpret a chart's message and predict a security's movements, he can obviously make a lot of money. Well, okay, remember, we're always talking about risk here. Okay, there's no great big promises, but the more work you put into it, the more likely you're going to make a better trading decision. Certain aspects of technical analysis are controversial, such as the belief that markets move in trends that can play out over long periods of time, and the contention that market action can predict shifts in supply and demand relationships. Now, the idea is to use a chart to identify trends and changes in those trends. There are several kinds of trends and patterns, some, like we said before, with unusual names, but the basics of a trend is very, very important. And once you've learned to read a chart, once you've learned the difference between a candlestick and a bar chart, the first line you need to put on your chart that every trader should be using is called a trend line. And a trend line has specific rules. Okay, it's not very complicated, but the whole idea is everybody wants to figure out ways to be outsmarting everybody else, out-trading everybody else, out-thinking everybody else. But before you can do any of those, you have to understand what the markets are trying to tell you. And trend lines and support and resistance lines are with firm rules. So what you're doing, and they are the backbone of technical analysis, because what you're doing is trying to figure out what price is important to the market. Not whether the market is going to send it up or down, but at what price should I see a market action? Okay. Now, again, you don't know what that market action will be, but if you can pinpoint a price and say the euro 117.32 should have an action or reaction, should go up or down, you could then wait for that price and isolate what happens at that price point. Okay. So it's important that you know what every other trader is looking at. By knowing what price is important to the million traders around the world, you can see how they respond. So let's go over, I have some live charts up here, and let's take a look at some live charts and a trend line. So hold on a second. Let me pop this up here for you. Okay, we're at the USGFX homepage. So if any of you want to go, just go over to www.usgfx and fill out the little form, and you'll be set up to be trading in no time at all. But let's go over and look at a simple chart I've got set up for us here. And this is a chart that I was just messing for class, and it's for Dash and Tether. This is for 2 cryptocurrencies, but we don't have to worry about those. The asset's not important. But this is a really bare basic chart. And it contains 4 vital pieces of information that are not complicated, that are easy for you to get, easy for you to learn, and easy for you to master. And they give you the backbone of technical analysis. And they at least help you make a smart trading decision that you understand. The first is a trend line. And this trend line is either an up line or a down line. You can have long-term trends, short-term trends, medium-term trends, and there are rules about trend lines. But you very rarely see anybody's chart that doesn't have trend lines drawn on it. A trend line serves as a level of support or resistance for price. Now, if you notice, price stays above this trend line, because one of the rules of a trend line is price cannot break a trend line. Otherwise, that trend line is over, and you need to establish a new trend line. But this tells us in an up-moving market, this trend line is supporting the price above this trend line. Now, if we look at this chart carefully, we see how price moves. Price moves in thrust and ease, thrust and ease, thrust and ease, thrust and ease. Okay, now, to use trend lines properly, you have to learn the rules. And you can come to our class to Trend is Your Friend. You can read about the rules on the USGFX website, or you can just go into the internet and read about them, because the rules for drawing trend lines are standardized. Because at this point, we can then, especially at these 2 price points, find very important trading information. We're starting to make some understanding of what is happening in the marketplace. Okay. And we can see this. This is a well-developed uptrend. Okay. So we're starting to interpret where price is, where price should be going, and how strong the trend is. Okay. This is just bare basic technical analysis. And why? We're doing it on a chart. So anything on a chart falls in the area of technical analysis. Then we have the next step that we use, which is called support and resistance. And also trend lines give you support and resistance. They support the price above where it is. Support and resistance is a critical part of technical analysis and should also be incorporated into all of your strategies or studies. Or if you're trading from fundamental analysis, however you're trading, you should know what the support and resistance levels are around the current price. Now, the support level, if you imagine price moving in an elevator. So imagine you're gold and I paint across your chest 1250. You don't have any hands, and I push you into an elevator. So what is supporting you at 1250? The floor below your feet. That's your support level. When price needs to move up, it needs to break through that ceiling above your head. So as you're moving up, what is above your head? The resistance. You jump hard enough in that elevator, or that elevator goes up enough, sooner or later you can go through that ceiling. Well, if you know what that ceiling is, and that ceiling, say, is 1255, and the floor below your feet is 1250, you've now started to make important trading decisions. Now, there's no rule that says price can't fall below or go above. But most likely, because price doesn't move in a straight direction, there'll be a time of hemming and hawing at each of these prices or each of these floors. Now, when price moves up and it breaks the 1255 level and the door opens and you're at floor 1255, what happens? That ceiling that was your resistance level now is your floor holding you up, and you have to go through that next resistance level. So what happened? 1255 now became a very important support level as you're moving up. And when that elevator moves up to 1260, when it's falling back down, or coming back down, not hopefully falling, there's a good chance it's going to stop at 1255. Now, if that was an elevator in the building, maybe that's the floor where all the offices are. Maybe that's a floor where there's a restaurant. Maybe that's the floor where the conference, and it's an important floor. When you know where these floors and these ceilings are, you can start making decisions about where price should move. Now, right now, we have two things on a chart. One, trend line. Two, support and resistance. Now, they're not complicated. There are rules. Now, the funny part about support and resistance, there's many ways to get these. You can get Fibonacci retracement levels. You can get them from Gann fans. You can get them all. You can get pivot points. Okay. But guess where most of them come from? They come from what we call eyeballing. Eyeballing is looking at historic prices and where price hemmed and hawed in the past. Okay. Now, the more recent past, the more important it is, but you have to go back because price, like if we're looking at this asset, wasn't at this level for quite some time. So we have to go see in the past and go back and see when price was trading at this level, what level might have been important. Where do we have lots of closes? Where do we have lots of opens? Where do we have lots of congestion? Now, we can see right away that we might have a support level or resistance level right here. Because look at this, when it was moving up, it hit this swing high and wasn't able to break through it and bounced off and came back down. And look at all of these resistance levels, how important this price has been also. So eyeballing isn't that difficult. It's finding significant price levels in the recent past, and sometimes you have to go far back in the past, that have been critical to price movement in this asset. Like we know gold at 1300, it's a very important level. Okay, how do we know this? Well, we know it because every time it tries to break 1300, it bounces off, falls down. It might go through at $1 or $2, but then it falls down through it. Now, it can go above. So when we see gold hit the $1,300 level, and we got our trend line going up, and we have a support, our resistance level, and it breaks that resistance level and maintains above that trend line, we knew at 1,300 we should get some type of action or reaction. We haven't made a trading decision yet. And in this case, hypothetically, the trading action was it broke above and kept going up. So you were looking for something strategic to happen at that price level. So these are basics, or your basic building blocks of technical analysis. So let's go back over to my PowerPoint a little bit, and let's talk a little bit more about what technical analysis is, so we don't just get stuck here. So it's important to understand that the realm of technical analysis is not limited to charting. Technical analysis is always primarily concerned with price trends. Anything that can influence a price trend is of interest to a technical analyst. A technical analyst would be alerted that a trend might change when these surveys reports of extreme investor reaction, okay, which are called indicators. The logic being that if most investors are becoming bullish, then they have already bought in the markets. Okay. So we can see the activity that's happening in the markets, bullish or bearish, how many buyers we have by something called volume, which again falls on our chart. Okay, volume almost is like common sense. If price is moving up and coming to a resistance level, we might expect volume to ease a little bit. But if volume maintains up, that means the traders are still buying into the marketplace, pushing that price upward. But if price continues to climb, but the volume starts to ease down, that's telling us a lot of people who bought earlier are already selling to take their profit. And we can see the change in volume. And when the change in volume reacts with a trend line and support and resistance lines, we actually can make, there's whole trading systems, there's black box systems that are only based on these three pieces of information. So these aren't complicated. But then we go on from here a little bit more using something called patterns. These are chart patterns that appear in price movement, and they're supposed to indicate the psychology of the markets. Okay? If you believe in the psychology of the markets, that's fine. But we can see these patterns appear on the charts. And we can see these in conjunction to trend lines and support and resistance lines. Now, some of these are called triangles. We have channels, we have wedges, we have head and shoulders patterns. But these patterns use price movement and support and resistance lines to tell us or help predict what market action should happen. So a triangle is one of the most common, and a triangle is formed between converging support and resistance lines. A negative slope resistance line indicates a reducing level of profit taking and more uncertainty about the value of a stock or an asset. With a positive sloping support line, the price levels are squeezed into a corner. Now, let's use a little bit of our common sense and our visual. So remember, charts are mostly visual. They're all about seeing price movement on charts. They're about seeing visual imagery. So when you see a pattern develop like this, and this is just price movement, this is the peaks and the valleys formed by that price movement, and you see price get pent up into the center of a triangle, we know that something has to give. And either the price is going to break up or break down. Sooner or later, something has to happen. Well, there are ways that you can calculate the momentum that's generated by the price break. So if price is moving down here and breaks down this direction, there are formulas that tell you that basically the momentum that will be generated by that price break will be equal to the distance between the ends of the triangles. There's a name for this. I forget what they are from my mathematic days. And you can then calculate that to figure out the target point. And this would then be an entry point. This would be your exit point. And your stop loss point could be all generated from this momentum and this breakout on a chart pattern. They're not difficult to understand. They're more difficult to see. So we have ascending triangles, descending triangles, symmetrical triangles. There are specific variations of triangles that can occur. Like I said, namely ascending and descending. An ascending triangle has a horizontal resistance line, and a descending triangle has a horizontal support line. Okay, in other words, an uptrend or a downtrend. See how when you connect swing lows and draw a support line, and then you connect the swing highs, okay, we then are forming a triangle. Here we have an uptrend. Here we're in a downtrend. Now there's no guarantee you that the breakout is going to be that way, a breakdown or a break up. But when it does occur, there are rules about what you can expect to happen. So when you're seeing this occur, because you're watching your charts, you can then make successful trading decisions. Now, it's important to note that an ascending triangle can be found in a downtrend. There is no reason why it can't have a small trend line, a small ascending or descending triangle in the opposite trend, because price moves in, like I said, peaks and valleys. But then we move on to something called volume, which I mentioned before. When it's an ascending triangle, volume usually contracts, although there are a few numbers of cases that volume has not contracted. But when we see this congestion and we see volume contracting, that's telling us that the traders are building up the momentum. They're leaving the market. They're waiting to see what's happening. Okay, and if you can interpret this, you can start forming decisions. Okay. We also have rectangles and channels. We have wedges. Okay. Understanding and memorizing all these isn't so important. It's just knowing when you see them what they're trying to tell you. Now, not all of us believe in all the chart patterns or all the complicated ones. There's something called a teacup. That's the most outrageous thing I've ever seen, but there's people who believe in it. Head and shoulders are very, very reliable. Now, wedges to me are virtually like triangles. Triangles are very reliable only because you can see price being pent up. Okay? So when you see that pent up price on a chart, you can then prepare yourself for action. Now, head and shoulders happens rarely, but when they do happen, they are very reliable. And they are exactly like what they're called, a head and shoulders. Now, you don't notice a head and shoulders until it's well into development, but it doesn't matter. You can't trade it because you can only trade it as it's ending. But here you have price move up above a resistance level, falls back down, then moves back up, falls back down. Now, there's rules. This forms what's called the neckline. And price moves up to form a left shoulder, then comes back down, moves back up to form a head, which is simply a peak that's higher than the shoulder, comes back down to that neckline, moves back up to form the next shoulder, and when it's forming this shoulder, you're now almost sure you're in a head and shoulders reaction. And when it comes down here to the neckline again, there are all kinds of formulas that you can use to trade that based on price action. And these all fall in the family of technical analysis. And lots of people think technical analysis is nothing but these complex mathematical calculations that you put on your charts. But understanding trend lines is the beginning of it all. It is building your proper foundation. It's no different than when an architect designs a building and the builder goes to build it. He needs to lay that first brick or that first whatever you call it at the exact right angle. He needs to make sure it's plumb. Otherwise, that whole building will be out of kilter. And so a trend line is one of the foundation blocks that you should be able to use. And it's one of the most basic concepts. You know, in a matter of hours, you can learn and understand the rules of trend lines. They're not difficult. Okay. It's just a piece of information. And these pieces of information can be used independently of each other, or they can be used together as a part of a larger trading system. So again, there are right and wrong ways of drawing these trend lines. I have lots of people tell me all the time, oh, I can always draw a trend line on a chart. I can always connect two lines together. The problem is, can you connect those two lines that have any value and any significance? And this is why you need to learn the rules. Okay, to get it the right way. So all you're doing is building your building blocks. Then you go on to support and resistance. Okay, this is easy. It's not a complicated scenario. It's not something you can't master in a few hours. And all of a sudden, you're using technical analysis to make or understand what is going on in the marketplace. So we have support and resistance, and we have trend lines. Now, let's go over and back to the charts and start talking about what all this other stuff is that everybody's talking about all the time. All this other squiggly lines that are put on charts. So let's put up a chart here. Now, the rest of technical analysis involves what we call indicators and oscillators. Indicators and oscillators are mathematical calculations that are put on charts, sometimes on the bottom, in most cases underneath the price chart, and you use these to judge how they're moving with price, or on top of price charts. So there's some that go right over top, like we're going to drop on here Bollinger Bands right now, and you see Bollinger Bands drops over top of the price chart. And it's a band or an envelope around price. And it interprets price movement. It's not a very difficult indicator, but it's an indicator. Then we also have other indicators such as stochastics and RSI, Or let's use MACD. MACD is one of the most popular indicators, and it's called MACD, Moving Average Convergence Divergence. And again, it uses two lines or two different mathematical calculations that go underneath the price chart and give you buy and sell signals. It gives you what's called convergence, when the two lines below, which is the MACD and this MACD signal line, converge and cross over each other. Or you can also see how they move in relationship to the trend. So in other words, here we see a very specific trend, and we see the price movement on the indicator matching that trend line. There are times when those trend lines will converge from each other, where you see price moving down and you might see the indicator moving up. Those are called divergences. They tell you something about the marketplace. Okay? And these are considered non-bounded indicators. And then we have what are called bounded indicators. And let me put one under, and that's called like stochastics. Stochastics and many of these bounded indicators are mathematical calculations that the outcome of the calculation is always between 0 and 100. And it's plotted on a chart below, and we have the 100, we have the 0 here, and you can set this, but in most cases it's between the 80 and the 20 is, we can call it boring zone, because it's not doing or telling you anything. When it moves over the 80 point, it's telling you an asset is overbought. When it moves below the 20 point, it's telling you an asset is oversold. So it's telling you something about the trend line. So we can see here that the trend and prices moved up, but it's holding right at the 80 line. So there's a good point where it might continue upward. When it becomes overbought, it means it's starting to weigh down. Now, these indicators and oscillators are usually lagging indicators and oscillators. They do not predict or give you necessary entry and exit points. They tell you something about the marketplace. And this is where we get complicated, because there's all different kinds of these with all different types of strategies and applications. And you can learn one at a time. You can learn to use a combination of them. You can use many of them, but you have to learn what they are, because you wouldn't want to use 3 overbought, oversold indicators. There's some that tell you, that predict momentum in the market. There's some that tell you when trends are going to be inverse. Some will generate buy and sell signal. So you have to learn what they are, not just because your buddy told you, well, I trade with RSI and I use RSI 14 and 21 and it always works for me. No. You have to understand and learn what they are. Learn their interpretations, because you can get very complex in your charts, or you can start very easily in your charts. But you need to start somewhere. And the best way to start is to learn and master a thing at a time. So if you can build your foundation, your building blocks, which are your understanding how to read a chart, what the different chart patterns are, what the different types of charts are, what a line chart is, a bar chart, what a candlestick chart is. If you want to use candlesticks, learn the 32 patterns and how to interpret the candles. Okay. If you want to use a bar chart, understand what the differences are. Then how to read the price on that chart. Then you have to learn what time frames are. Time frames are you looking at a 15-minute chart, a 1-hour chart, a 1-day chart? Okay. Once you've learned all that, then you can put your trend line on, and you can put your support and resistance, and you can look at your volume. And you've got the fairly good foundations, the building blocks you need to start building a trading system or building a trading strategy. And because everybody has to start somewhere. So whether you're going to trade from fundamental analysis, whether you're going to trade from technical analysis, because also if you trade from fundamental analysis, and you, again, back to the Apple story, Apple is going to go up. Wouldn't you like to know what point you think Apple might go up to, or where you should be watching Apple to get some resistance? Because if a price hits a resistance line and doesn't break through it, most likely it's going to ease back down. So maybe you want to get out of the market at that point, especially if price has hit that resistance 2 or 3 times and hasn't been able to generate the momentum to break out. Don't you want to know where you should put your stop loss? Or At least it gives you steps to grade how the market is moving. So this is your bare bones basics. And then from here, you can go on to complex. But here's a beautiful chart on Bitcoin and the dollar. Very simplistic. Okay, very easy, using a candlestick pattern, a trend line, and using one indicator, and using a support line. Okay. And this would have been a very good trade because you entered the market here at this point. You would have made profit up until that point. Now, here's a little bit more complex set of charts, but they're not that difficult that you can't master these in no time flat. Okay, then we go over things like this is an Elliott wave pattern. This is a very complex thing. Okay, it's going to take you a long time, not to read and understand it, but a long time to be able to interpret it. But when you do, Elliott waves takes advantage of the way price moves. And price usually moves in 5 waves up, and then 3 waves down, and then 5 waves up. But once you understand how to find these waves, you can make trading decisions. But you have to learn these. Some of them are more complicated than others, but you need to start somewhere. And getting started with the bare basics is where you should be, because you need to build your understanding levels. You need to build that building so it's plumb, so it doesn't start to topple over. Okay, so you're not going back and having to restructure and put new supports in, because you're making intelligent decisions and knowledgeable decisions from the very beginning. So we can look at all different types of things, because even support and resistance come in many different ways. We can use pivot point resistance, swing highs and swing lows to locate our support and resistance. So you can spend a little bit of time. It's not scary. It's not great big complicated science. But then when we go on to oscillators, indicators, that gets to be a little bit scary. Because remember, indicators are calculations based on price and volume of an asset. Indicators are used, and this is important, as a secondary measure to the actual price movement. Too many people want to make these their primary decision makers, but they're not. Indicators are secondary. Indicators are used in 2 main ways: to confirm price movement and the quality of the chart pattern, and to form buy and sell signals. Now, there are 2 main types of indicators, leading and lagging. So before you even learn them, you have to understand what categories they fall into. And a leading indicator precedes price movement, giving them a predictive quality, while a lagging indicator is a confirmation tool. There are very few reliable leading indicators. Then we have oscillators, which is what we talked about, bounded oscillators, which fall between 0 and 100. Some fall between 0 and a 0 line, a 1 and a -1. But they all fall in specific ranges. No matter how you do the calculations, they come out in those ranges. But then we have crossovers, and crossovers are the most popular, and that's what I showed you on the MACD chart, where the 2 lines crossed over. But you can have a simple trading system using technical analysis, using a moving average. And you can have, say, a 9-day and a 15-day moving average, and when those moving averages, which are put on your price chart, cross over on the price chart, and the one crosses the other, it can give you a buy and a sell signal. And then the other way is divergences, which I showed you when an indicator works in the opposite way of a divergence. So I'd like to thank you very much for joining us tonight. If you want to see a recording of this class, you can get that by using the link you used for today's webinar. And you can also go to usgfx.com and open up an account with that and start learning how to use all of this stuff. And I'd like to thank you very much for joining us. A few of you have asked questions that I just can't answer for you because we are regulated. We can't give you trading information. I can't give you trading systems there, because we're not allowed to give you advice. I can give you education. Okay. So for those of you that asked very specific questions that weren't answered, it's just because as a regulated provider, we can't give you those pieces of information, or we can't tell you our thoughts. But thank you very much for joining us. Please give USGFX a shot. and come back and watch our webinar. We're going to be doing another webinar next week for USGFX, and we'll be talking about building a day trading strategy. So if you learn how to use some of this stuff we talked about, we can actually build it into a day trading strategy next week. So thank you very much, and we'll talk to you again real soon. Have a great day now. Bye.